Well, hello, Perennial Pride listeners. Really excited today. I have a special guest, Jeff Huston, who's the owner and founder of 3D Money, which I love that. Always love that name, Jeff. So really excited to have you on here. I've known Jeff for a number of years as I was getting into the financial space. And, I remember meeting Jeff at a conference that I was kind of newly introduced to. And he just was so generous with his time and sharing, and really enjoyed meeting him and keeping a strong relationship over the years. So I think you're going to get tons of value out of him and his journey in the financial world, and learn about potentially a new opportunity for you as investors to learn about alternative investments. So Jeff, really welcome to the Perennial Pride podcast.
Hey, thank you, Tom. Appreciate the opportunity. Looking forward to today.
Awesome. Yeah. And, you listeners, you'll get a good flavor for it. Jeff's, I think over all the years I've had conversations, and I sort of invested with Jeff, and we've always had such a calm demeanor. I always feel better when I'm chatting with you, Jeff. And and especially in today's world, it's a much needed thing for all of us. So
Absolutely.
you'll get that. So Jeff, before we kind of get going into kind of some of the different topics I kind of wanted to chat about, can you just share briefly sort of your background? I know you have an extensive history, and sort of how it got to where you are today with 3D Money and your area of focus.
Yes, be happy to. So I started as a financial advisor in the mid 1980s and spent 25 years building a financial services practice, which we'll talk a little bit about because there's something that's germane to, I think, our current market conditions, some realities that I think it would be valuable for your listeners to hear about. But so I spent 25 years really as an insider in the Wall Street mechanism. And then in 2010, I sold my practice. And so in 2010, I had, some money from the sale of that business. And I have a son-in-law who at the time, he was a youth pastor and really felt that God was calling him out of the ministry and into something else. Wasn't sure what it was, but he had a background in, some construction and kind of knew how to do a lot of rehab things and a lot of things, mechanical things with houses and physical properties. And so in 2010, Tom, as you remember and your listeners will remember, the housing market was bad, or it was good, depending on your view. And we started buying houses in the downturns, and we started in 2010 and spent a couple of years buying 40 single family homes. And then in 2012, we transitioned to multifamily apartment buildings. We got an opportunity to buy a 26 unit apartment complex, and really haven't looked back since. But what I want to do is I would just pause there, and I want to go back, and I want to talk about, kind of my experience as a financial advisor and how that played into what I do today or what our company does today. And it really comes back to, I didn't know when I started in the 1980s, I didn't know anything about being a financial advisor. So the financial institutions, they taught me how to be a financial advisor, and taught me what they thought was important for me to know. And I was taught that there was basically there was two places that you could put my clients, that a person could put their money. You could two buckets, if you will. You could put it in the safe and secure bucket, which would be, bank CDs or fixed annuities, fixed and cash value life insurance, those types of things. And then there was a risk bucket, stocks, bonds, and mutual funds type of things. So for the first 15 years, I spent my time helping clients navigate the allocation between those two buckets. And then in 2001, I had what I call a red letter day. I term it as that because, in the Bible, they put Jesus's words in red letters because they want them to stand out. So a red letter day for me is just a day that stands out. And in 2001, there was a gentleman from my broker dealer at the time that came into my office, and he introduced me to the world of alternative investments. And being, I was a successful financial advisor. I was consistently operating in the top 5% of all of my peers at that time. And I've been doing it for 15 years. And so I was embarrassed. Quite frankly, I was embarrassed that I didn't even know what they were. I didn't even know what an alternative investment was. And so, but I quickly saw, as he explained it to me, I quickly saw how an alternative investment could play a key role in that allocation of my client's portfolio. And so I did about a year's worth of due diligence. And then in 2002, we started offering alternatives to our investors, to our clients. And between 2002 and 2010, when I sold the firm, we placed over $100 million of client money into various alternative investments. And over that period of time, I learned a lot. I learned that there are some really good things about alternatives, and I learned there are some not so good things about it. And, Robert Kiyosaki, you and I, we have had discussions about this, Tom. I like Robert Kiyosaki, and he's Rich Dad, Poor Dad is the best-selling finance book of all time, which is saying something, right? But when that book came out, that was like a bombshell. The financial institutions and Main Street media, they had conniptions over, because he said, hey, your house is not an asset. He said that savers are losers. He said that the go to school, get a job, right, and let the company take care of you was not a good thing. And so, I like that thinking. And the Main Street media, or the kind of that whole Main Street thing, is I push back a little bit from that. A little bit of a variant.
I get you. And to that point, the way and I appreciate you kind of giving that history behind that, because I think that's probably, in this day and age where, most investors, or, the mainstream investors would say things like the stock market is, that is the place to invest. Like I said, that bucket. And they assume it's safe and secure and has all the regulations, but doesn't guarantee that the investment's any good, right? They have all so your point, those sort of touch points and structures to, that maybe are invisible to most people, that adds costs and all these other things and mystery behind it. But it doesn't mean that the investments are safe, right? But for a lot of folks that are invested, they seem comfortable with that because they assume it is safe.
Yeah. And so, and let's talk about that, because I had somebody recently ask me, what's my investment philosophy? And, it really dates back to, there was, in the early 2000s, was the first time that I heard the term, don't fight the Fed. Don't fight the Fed. Early 2000s. I had no idea what that meant. And then I started reading books like G. Edward Griffith's Creature from Jekyll Island, Richard Duncan's book, The Dollar Crisis. And actually, let's talk about that just for a minute, because he said, Richard Duncan talks about the history of the dollar, the history of fiat currency, currency that is, because in August 15th of 1971, Richard Nixon took the dollar off the gold standard. And that was the day that put us on our current path to cash becoming trash. And we're there, banks don't even want your deposits. I have a good friend that owns a bank, and he said that, it's the craziest thing I've seen in 30 years. we don't even want the deposits. So I said, why don't you want the deposits? Well, because we can't even deploy it as fast as what the money's coming in. Cash is trash, He said, I said, well, are you raising rates now that, the Fed's been raising rates? Are you raising deposit rates? Are CD rates going on? No. He says, we're actually lowering our rates because we don't want the money. We want to shrink our balance sheet, right? So, when Richard Nixon took the dollar off the gold standard, that set us on our current path of cash becoming trash. So anyway, back to this Richard Duncan in the book, The Dollar Crisis, he spends about, 350 pages, kind of building a case for, of all the statistics of why the demise of the dollar is imminent. And then he says towards the end of the book, he said, made the statement, the demise of the dollar is imminent. He said, that is not in question. And he's just spent 300 plus pages, laying out why that's true, right? He said, that's not in question. But he said, what is in question is, will it be death by fire or death by freezing? So death by fire is hyperinflation. Death by freezing is deflation. And then he finishes the book by saying, fortunes will be made and lost on the answer to that question. And when I read that, it's like, okay, let's just think about that for a minute. Because why will fortunes be made and lost on the answer to the question of whether it's death by fire or death by freezing? Okay? Well, because you play your game totally different. The economic rules are completely different, right? So let's just walk down for a moment, kind of both paths. Death by fire, which is inflation. Well, what is the smart move? If inflation is in our future, is our long-term future, then what does he want? Well, you want hard assets. Cash is not the place to be because it's continuing to decrease in value, right? Since Richard Nixon took the dollar off the gold standard in 1971, the dollar's lost 90% of its value. How long will it take for it to lose the other 10%? Nobody knows, right? But so if it's inflation, you want hard assets because those are going up in value. You want debt, right? And you want fixed, low interest, long-term debt. You want to lock in your debt. So if you take somebody, I know somebody that they bought a house 25 years ago and they financed it on a 30-year mortgage. And maybe somebody, or your listeners know somebody if you know what their payment is, it's like really small. So, everybody else who's buying a house now would love to have that payment. Why? Why is that? Well, it's because, they bought it because inflation actually worked for them, right? They had this long-term debt and inflation worked in their favor. So if it's inflation, you want hard assets, you want debt, you don't want cash. That's what inflation looks like. Now in deflation, if deflation is the deal, it's totally the opposite, right? Cash is king in deflation, right? You don't want hard assets and you don't want debt because all those things are working against you. And so when Richard Duncan says, fortunes will be made and lost on the answer to that question, and I realized when I read that book, 15 years ago, that I've got to make a decision of what path do I believe? And so I kind of looked at what the signs of the times were. And, I asked the question, do I think that the government, I don't care which party we're talking about, do I think that the government is going to make fiscally responsible decisions? Do I think that they're going to balance the budget? Do I think that they're going to stop the spending spree? I think it was Thomas Jefferson that said, a democracy will only survive until its people figure out that they can vote themselves entitlements. Okay? So, we're there, right? So, okay, I look at that and I go, well, you know what? I think there's a better chance, if I'm playing the odds, I think there's a better chance that the government is going to continue to give the people what they want, which is, hey, spend, right? Do I think that the central banks are going to rein in monetary This is it. And, when I read that book was before Ben Bernanke was ever a Fed chair, but he was famously said, when he was a professor, a skilled, learned professor, that he said that a central bank can always create positive inflation because they have at their disposal a printing press or its modern equivalent. And so, okay. And then that was his thinking. And then he became Fed chair and, the Fed balance, and then Janet Yellen and, now Jerome Powell and, so the sequence, but the sequence is the same. They continue to print money. The balance sheet is, has swelled to unfathomable amounts. And so the question is, do we think that so I made the decision a number of years ago that I think it's going to be death by fire. And that has driven my investment strategy, personally ever since.
Yeah, that's fascinating. And you hear these days, especially to your point where it's, the amount of money that's been created, like I said, globally too, whatever that trillion number is, 25, 30 trillion, you hear these numbers and it's not like it's slowing down quickly,
right?
It's still on the balance sheets, right? And it's, how long they kick the can here. It seems like it could be for quite some time. And so with that in mind, with the death by fire, right? So this is maybe leads into a nice segue into kind of what it is you are focused on in 3D Money and how this sort of leverages that.
Yeah. So I was recently asked about, how I have my money invested. I have about 10% of my net worth is in a balanced portfolio, only 10%. I'm 90% in real estate. Warren Buffett famously once said that, diversification is for people who don't know what they're doing. And so I'm not against diversification. I wouldn't suggest that people, be 90, that your listeners go 90% into real estate and 10% into an invested portfolio. But it's right for me because I'm a student of what I do. I know what I'm doing in the real estate business. And from when I was a financial advisor, we managed a lot of money for a lot of people. And when I looked across my client base, it was surprising to me to make the observation that none of the people that I ever worked with made their money in the stock market. Now, they might store their money in the stock market, but they didn't create the wealth in the stock market. And so then the question, well, where did they create it? Well, it was really two places. They either made it in real estate or they made it in a business.
Mm-hmm.
And I'm including under the business, maybe I had clients that, they got stock options. They, took a golden parachute. They, had those types of things. And so I put that under the business mechanism. It really wasn't Wall Street that made them that money. It was the business that gave them the stock options that made them that money. And so real estate, there are people who don't like to call real estate an asset class and, not to debate that, whether it is or isn't, but just to say, if you call it an asset class, real estate has created more millionaires than any other asset class, period. And so I have been focused on real estate for much of my life. Even when I was a financial advisor, I loved talking with my clients about incorporating real estate into their portfolio, income producing real estate. And also, debt is a very, I would break with, you take Susie Orman or Dave Ramsey. And I think that I've seen their advice do some really good things for certain people. I can't deny that. There are individuals that absolutely need to follow that advice. For a investor such as myself, I would not follow that advice. Let's just talk about debt. I mean, debt is, I've quoted Warren Buffett a couple of times, but, he's famously said that, debt accelerates returns, but it also accelerates losses. So, you need to approach it carefully, and you need to understand debt, how to use debt wisely. But the thing is when the dollar went off the gold standard, what a lot of people don't realize is that the dollar actually became a debt instrument. So we think, oh yeah, I've got $10,000 in my checkbook. And so $10,000, that's an asset. And we put it on our balance sheet as an asset. But what we don't realize, and this is really hard to get our minds around. I mean, it's hard for me to get my mind around it. And I've been working to get my mind around it for a couple of decades. But what's underlying to that, what we call an asset, is actually debt, right? And so people say, oh, we should pay off the national debt, we should reduce the deficit. Actually, our whole economy would implode if we did that, because the dollar is a debt instrument. And that's a very contrarian to understand from an economic standpoint. So, but it begs the question is, how much do I understand how to do debt? How much do I understand about how to utilize debt wisely in my economic model? And, to me, very simply, good debt is outsourced to someone else. So bad debt is debt that I'm paying for. Oh, I love to go on a cruise. I don't have the money. So I, charge $5,000 on my credit card, and then I get home and I work the next 6 or 12 months to pay for it. I had a great time, but I got to work to pay for it. That's bad debt. Good debt is outsourced to somebody else. So when we get an apartment complex or we do a rental piece of property, and we have debt on it, but our tenants pay us every month, and we use that money then to pay down our debt. So it's outsourced to somebody else. So understanding the wise use of debt is really key, and because our money is actually a debt instrument.
And it goes back to the thing you mentioned before around, what's backing up your investment too, right? And,
Right.
In this sort of situation with an asset like a apartment complex, which I know you heavily focus on, and to your point, the concept of debt scares some people. And, I know there's people that will avoid it like the plague because they're probably following like a Dave Ramsey or Susie Orman. And for to your point, some people, they need to. A good thing.
Absolutely.
Right? Because you have to be responsible. But I always hark back to the concept of, and it's just a simple change in words, like whether you have debt or you're in debt, right? You're in debt to your point, you're having to pay this, right? You're in debt.
Yeah.
But I have debt if, it's being used productively, and someone I love the way you phrase that, like outsource the payment of it, right? I love that concept. And that's how you actually can win in that game. So but to your point, you got to know what you're investing in, and understanding who you're working with. Like if investors are working with you in your organization, Jeff, right? Knowing you guys and how you guys operate. So can you talk a little bit more around maybe your model today, kind of how it's evolved, and maybe, taking today's unique environment, is there anything that's sort of changing or that you're looking at?
Yeah. So, because I was a financial advisor for a long time, I really view the world through the eyes of a financial advisor. And a great financial advisor views the world through the eyes of his or her customers. And so when we begin to design our program, we really designed it with the investor in mind. And there's a couple of unique things that we do. And just to back up to say, so in 2010, I sold my practice. And at between 10 and 12, we were buying individual houses. And I was just doing that with my own money. But then when we started in this apartment complex thing, and all of a sudden you're buying properties that are multi-million dollars, and sometimes the rehab alone, to improve the property is $1 million. but certainly hundreds of thousands of dollars. It just, it was beyond what my financial capability was. So, of course, we go to banks for as much as they're willing to give us, but there's always, a down payment, and there's always the rehab, and there's always the stabilization costs that have to be funded from someplace. And so in 2012, that's when we retained Securities Counsel, and we got on a path to creating our own alternative investment. Kind of taking a page. I kind of jokingly say that I spent 25 years raising money for other people's capital endeavors, right? So the insurance companies, the annuity companies, the mutual fund companies, the investment companies. I spent 25 years raising money for other people's capital endeavors. And I just, kind of made a switch that I was going to still raise money, but I was going to raise it for our own capital endeavors instead. And so what we did is that we retained Securities Counsel, and we became a sponsor of our own offering. And it's real estate focused, cash flowing real estate focused. We do a few other things, if we have, like maybe we don't have a real estate deal that's available, but we'll do some bridge financing of some other things. But it's really all, either primary or secondary real estate type of backed and real estate. So that's the kind of the two things that we did that when we designed it that I think are a little bit unique. One is, I already mentioned this, is short term. So a lot of these alternative investments are long term, 8, 10, 12 years type of thing. We kept ours. We created a model where it's short term. And I would actually, from a financial advisor standpoint, I would actually love it if it could be less than 3 years. But I can't get done what I need to get done in a year or two, because basically you buy this underperforming property, and it's kind of a 3-year process that it takes us to get it turned around. Year one is about rehab and, improving the property and repositioning the management, kicking out the drug dealing tenants and getting the families in, putting new playground equipment in, LED lighting, just kind of new laundry and vending, just get the families to come back in. You kick out the bad people and the good ones, and you improve the property, make it a nice, safe place, and the good people want to come back. So that's kind of year one. Year two is then you begin to stabilize the financials. These properties are all valued based on net operating income. So if you increase the net operating income, so you increase the rents and you manage the expenses, right? The net operating income goes up, and that means and so that's kind of what year two is about, is increasing the net operating income. And then year three, we take it and refinance it. So then we'll go to the long-term capital markets, the securitized mortgage market, Freddie, Fannie. So what our investors act as is really partnering with us in rehabbing these housing projects, and they bridge finance us. So we use community banks and investors to bridge finance us over that 3-year period of time. And then when we refinance in year three is when the liquidity event happens for the investor. And what the investor then has the choice when the note matures is either they can take their money and go elsewhere, or they can reinvest for another 3-year note, which is another one of our projects. So kind of the first thing that I think has proved what our investors would tell you or would tell your listeners that is unique is it's the 3-year term. It's shorter term. The other unique thing is that we are a debt offering versus an equity offering. And what that means is a lot of these private placements, syndications, Reg Ds, all of these different names for the same animal, typically the investor becomes a part owner. And there are advantages to that, but there are also disadvantages to being an owner. And it's a much more complicated transaction. The income comes through as K1. There is some depreciation and those kinds of things that happen for investors, but you take a part of the risk of the transaction. And so we chose to do a debt offering. And so it's a fixed interest rate. People, they get 6% interest on our investment. They get it for 3 years. It's a monthly check. So somebody puts in $100,000, they're going to get that's 100,000 and 6% is $6,000 a year, divided by 12 months is $500 a month. So they get $500 a month for 3 years, and then they can, again, either take their 100,000 and go elsewhere, or they can reinvest in another 3-year note. So, which, by the way, about 82% of our investors reinvest with us, and about 18% take their money and out. I think some of those people, actually, it kind of proves out, some of them take their money out just because they want to prove that, oh, I actually can take it out. And then, 3 months later, they put it back in. So, but we track that as those are people that they're surrendering their money, we're paying them out. And then, many of them end up coming back in again. Yeah, that's kind of the 3D story.
No, it's really great. And for listeners, like, and who are you probably attracting to something like this, right? Because, the angle of equity could be a nice draw, especially if you're thinking about taxes, but this is a steady stream of income that's backed by a substantial asset, right? Not in exposed position of an equity. So like who's typically sort of, are you serving to?
Yeah. So the profile of our investor probably falls in one of two categories. But they have one mindset. The one mindset that they would have is that they are concerned about the economic path that we're on. They're concerned about the risk of Wall Street, the risk of that, risk bucket. And they're also concerned about, the super low interest rate interest we're in right now, because that really feeds into the two profiles. So the first investor would be someone who is, maybe 40 to 60 years old. They probably have a self-directed IRA. We're set up so that we can, with a few custodians so people can invest IRA money with us. And typically those investors would be using this as a bond alternative. Maybe they have $300,000 in a self-directed IRA. It's, probably in a stock bond blend anyway, maybe 60% stock, 40% bonds, which would mean 40% of $300,000 is they've got, $120,000 in bond portfolio anyway. Well, where can you find a 6% paying bond? Right. So they're taking, they'll maybe take, we'll take $100,000 of our, bond allocation, and we're going to put it into 3D. So that would be profile number one: qualified money, people who are in the accumulation years of their life. And then second one would be, the second profile is people who are more in the preservation years, preservation or distribution, meaning that, they're in the income years, and it's a fixed income alternative, a CD alternative, if you will. Because, CDs, I got $1 million in CDs that I'm getting 1% on, right? I can't live on $10,000 a year. And so they're doing this as a bond alternative, or I should say as a fixed income alternative or a CD alternative. That would be kind of the two profiles of people that work well with us.
Okay, that makes sense. And so at this stage, this is the only offering. There isn't an equity offering today.
For the first time, yeah, we did do an equity offering last year, and we do still have a little bit of that offering that is available to certain accredited investors. But yes, but generally our plain vanilla, kind of our mainstay is our 6% account. And
Awesome. Awesome. And I know you had such a tremendous track record with your investments. And I know we always talked about it. You have a very tight window of what meets the 3D money sort of criteria for a good investment. And you got a tremendous model going on. So if folks are interested in learning more about how best to connect with you, Jeff.
yeah, probably the best way is just to go to our website at 3dmoney.com, and you can connect with us that way, and we can engage with you in a conversation.
That's great. Yeah. I actually saw you just must have updated recently. Looks great.
Hey, yes, we did. Just did a refresh.
Wonderful. And you should go there. I took the quiz there. There's an interesting quiz there to see if you're a good match for Jeff and his team. Really fun. But if you have a chance, certainly I would entirely encourage you to reach out to Jeff. Tremendous expert, and will give you the lowdown and the truth about things. And he's a great resource for you. So, Jeff, I really appreciate this. Any last parting shots you want to leave with for the Pretty Pride listeners?
I wish I had a magic bullet, but it's just take it seriously, right? My wife and I, we do quite a bit of coaching and mentoring to young couples, young married couples, couples in their 20s, 30s, and 40s. And one of the reoccurring themes that we talk to them about is how important intentionality is in life. And and I think, I don't know if that's deteriorated. To me, it seems maybe like it has. Like, people are not nearly as intentional with their lives, whether it's intentional with their relationships, intentional with their health, intentional with their spirituality, intentional with their money. It kind of goes across all spectrums.
Mm-hmm.
And so my encouragement is, we're talking about money today, so I'll hone in on that. But it matters, if you have been entrusted with resources, and you might not feel rich, but for those of your listeners who are living in America, we're all rich, right? I mean, we have amazing, roof over our heads. I mean, for most of us, we even have houses for our cars, right? And so we have been blessed with an incredible amount of opportunity. And so I'm in the camp that we need to be intentional about stewarding that wisely. And to me, that begins with surrounding yourself with really good people and who can advise you well. It's been my goal, my objective, is, I love it when I can be the dumbest person in the room because it means that I'm surrounded by really smart people that are smarter than me. And so surround yourself with smart people, be intentional, because money matters. And this is not a time to be casual with your money. There's a lot of eroding factors that surround our wealth and our money. And so my kind of parting message is, be intentional, surround yourself with really good people.
That's great. No, tremendous message, Jeff. And I couldn't agree with it anymore. And it's, part of the reason I started this podcast, to help people do exactly that, and be surrounded and learn from experts that in their own spaces, so people can find their path, right, for their lives, their finances, and impacts where they can. So thank you so much for your time. I really appreciate it. And certainly, everyone, I encourage you to reach out to Jeff to learn more. You'll definitely benefit.
Thank you for the invitation, Tom.
Thanks, Jeff.
Thank you for being with us here today on the Pretty Pride podcast. It's an honor to be a small part of your journey to financial freedom. If you gained new insight on today's episode, please follow us on your favorite podcast app, such as Apple or Spotify, and follow us on our YouTube and Facebook pages. Also, we always love feedback on helping to improve what we're doing here. So please provide in comments and questions so we can make this podcast even more helpful for you.